Modeling, Topic 8, Section 3, Understanding the Static Personal Financial Modeling Using Consumption Smoothing. So let's talk about the pre-retirement buildup of income. We've already talked about in the last couple sections, we first have to make assumptions about the capital markets, expected returns, volatilities, correlations, covariances. And then we have basic biographical information about our person's 21 years old, is going to retire at age 65, has $55,000 a year of income now, is going to save 15%, and expected to live to 85. And then we talked about consumption smoothing. This person will need 63% of their income replaced in retirement to smooth their non-housing consumption. So what I'm going to do now is, starting at the age of 22, since they're 21 now, and notice I have some if statements in the spreadsheet that pick up if they're 21 here, this starts at 22. And what you'll notice here is after the age of 65, which we specified as the retirement age, it turns into blanks. So you don't get any errors in the spreadsheet. So we have our age from 22 to 65. We have our asset allocations. Notice I have these as the input format. And however, I do have a statement in there to look up using some lookup statements. It's going to look up the Vanguard target date glide path. In other words, if you're in one of those target date funds, the 2050 fund, 2060 fund, and so on, which correspond to roughly the year you're going to retire, this is just a set of weights that are in the Vanguard fund, broken between U.S. stocks, foreign stocks, bonds, and money market. Those weights add up to 100%. But you can do any weights you want in here. You can make it an all U.S. stock portfolio, whatever you want. So I do have a default set in here as the Vanguard target date glide path. In other words, asset allocations over your entire life. Now, we're going to start off our portfolio with $0 because that's what I said I have right here. I then need to grow that portfolio at some percent. I'm going to use the expected return of 5.04% in the first year, because I'm going to use these weights times these returns. Again, these are real returns. And how I do that in the spreadsheet is I use an M-mult, a matrix multiplication, in which I take the weights, which are in a row, times the expected returns, which are in a column, and you're allowed to take a matrix multiplication of a row vector times a column vector, so I didn't have to transpose anything there. So I just simply take the weights times the returns, and I copy that formula down. The portfolio volatility takes the weights and the covariance matrix and calculates the standard deviation of the portfolio. How it does, it uses kind of two matrix multiplication statements, and what it does, it takes in the first matrix multiplication, it takes the weights row times the covariance matrix, again right here, times a transpose of the rates row, and that does that ensures we calculate the portfolio standard deviation correctly. I then calculate my family income. My family income is I'm making $55,000 a year. I said that grew at 3%, so my salary grows at 3% forever. And then my personal contribution, I said I'm going to save 15% of my income, so it's simply 15% of this for my pre-retirement years. And then housing expense, I said housing expense will always be 25% of my income pre-retirement, so this is just 25%, and this becomes important later when I retire. And this also is the key number we're going to use at retirement. This is my non-housing consumption. So even though in this model I was making $55,000, currently I'm going to make $55,539 at age 22. I'm actually living on non-housing consumption of $22,216. The difference there is I'm taking out savings, and I'm taking out housing, and I'm taking out taxes. So all of that comes out. That means I'm living on $22,216 for non-housing consumption after tax. And then the key thing in this spreadsheet for building up of my retirement portfolio is this calculation right here. I'm going to take my prior year's balance times 1 plus the expected real return of my portfolio, and then add my personal contribution plus any company match. So let's go to the spreadsheet and see what this looks like for my client. So again, notice I have a lookup, a vertical lookup that looks to this topic right, or this worksheet right here. And these are the asset allocations roughly for the Vanguard funds. And what I can show you right here is this graph shows me that the Vanguard funds are about 54% US equity while you're in your 20s and 30s. And then the difference there at this 36% is the lighter blue. So if I add the 54 and 36, this is the equity percent of 90% up until you're 40 years old about. Then as you get older, towards the age of 65, 70, 75, what happens is the equity portion begins to shrink, the bond portion begins to rise, and money market and cash. And so what happens is at some point it gets into steady state. So when you're 95 or 100 years old, what happens is it's just using these asset allocations. So using these rough asset allocations, I have set up a lookup to tell me that at age 25, I'm 54.36 in stock and no bonds. By the time I'm 65, I've got these amounts in stocks, 32% in bonds and 19% in money market. And then you'll notice later down here that when you're 100 years old, you still have 30% stock, 38% bond, 32% cash. And at that point, it's steady state. So that's where the asset allocations come from. I then calculate my portfolio mean, M-mult, times my weights, times my returns. And notice I have an if-then statement there. And the if-then statement is simply there. So when I copied this formula down, I don't get any errors here. Now notice how my spreadsheet works. Notice it ends on age 65 and these are blanks. However, if I say I'm going to retire at age 66, I'll change that to 66. Notice how the 66 magically appeared with these new weights, and it picked up here at 67 in post-retirement. I'm able to do that because I have statements in here that says if you haven't retired, put in the formula, but if you have retired, put in a blank. So that's why it looks a little confusing there with these if-then statements. They're simply so this doesn't show up with errors or miscellaneous data. So let me change that back to 65 years old. Okay, so from age 22 to 65, I have my asset allocations, I have my portfolio means, I have my portfolio volatility, which is an M-mult weights times covariance matrix times the transpose of the weights. I have my family income growing at 3%. I have my personal contribution of 15% of my income. I have my housing expense of 25% of my income. And I have my non-housing consumption, which is taking my income, backing out my taxes, backing out my housing, and it says I'm living on $22,000 a year. And then my static portfolio, in other words, static meaning it's not stochastic or not random. This is a single point estimate. I start off with $0. That $0 grow at 5.04%, and then I'm going to add 8,000 to my portfolio, and then that's going to copy below. And what you basically have is your portfolio growing by this percent and adding these contributions, which are growing with your salary increase. One thing I do want to point out is these are real incomes and real portfolio values. So notice if I have my salary grow at 2% and inflation is 2%, my salary no longer increases. In other words, it's staying constant in real dollars. However, I'll make the assumption it grows a little faster than inflation. So what you see is I'm actually increasing the real value or the real consumption value of my or buying power of my salary over time because it's growing faster than inflation. Also notice that these portfolio values are not actual portfolio values you'll observe in retirement. Let's go down to the bottom here. At age 65, I expect to have $1.146 million. However, these are real returns, not nominal returns, right? The nominal returns are about 2% higher than this number. So the reality is I've actually calculated this base case model, which I'm going to have in real dollars of $1.1 million in retirement. What I did is I took that $1.1 million here using a VLOOKUP. Now the vertical lookup function, you specify an array. I say find my age 65 in the first column and give me the value in the 12th column, which is L, and it just found that $1.146 million. However, I then grossed up that $1.146 million by increasing it by 1 plus the inflation rate for the number of years from age 21 to age 65. So in real dollars, I've saved $1.1 million, but at age 65, when I actually look at my account, it'll be $2.7 million. Also, my salary in real dollars is $84,000, doing a lookup on that salary in my last year. However, if I increase that by the rate of inflation for that number of years, I'm actually, my last paycheck, or my last tax statement in my last year of working says I made $201,930. So these are the nominal and real incomes at my last year of work. This is my nominal and real portfolio values. And I do a couple calculations here. The wealth to income ratio is an important financial planning ratio I've talked about in the last topic, and that is the wealth to income ratio. If I take my $1.1 million over my real income, I've saved 13.6 times my last year's income, which is a very good savings or wealth to income ratio. A lot of financial planners say you need to have at least, say, 5 times up to 15 times. So this is pretty good. Also, I have a couple more statistics we're going to talk about. So these are the basic statistics out of my portfolio model. However, to get to these last ones, I want to talk about not just the pre-retirement buildup of cash, which is calculated down here, but if you go to a little bit lower, it picks up in my retirement years. So let's talk about this for a few minutes. In retirement years, I continue to get my asset allocations. Again, you can type these in, or you can just leave the defaults if you're in, say, a 2050 or 2060 fund based on your year of retirement. I still have my expected returns and volatilities. And let's talk about how to calculate, or how I determined the amount of money I start withdrawing from my portfolio in retirement. And let's go back to the PowerPoint. So this is the spreadsheet, and let's talk about kind of the 4 steps to figure out how much money will I start withdrawing from my portfolio in retirement. The first thing I figure out is how much income do I need? I'm sorry, what level of consumption will I need in retirement? Now, that says $35,485. Let's go back to the spreadsheet. I'm going to change an assumption here. I'm going to change an assumption that in retirement, I don't have any expenses going up. If that were true, look at my non-housing consumption grow over time, and then in retirement, notice it stays exactly at $33,795. This is a situation in which your housing expense, your expenses do not grow. So in order to preserve your non-housing consumption or smooth your non-housing consumption, it would stay constant over time. But I'm going to make the assumption, however, that expenses go up 5%. Let's think of it as additional healthcare expenses. So to smooth my consumption with increased healthcare expenses, this number jumps up by 5%. So that's the first step in calculating the amount of money I need to withdraw from my portfolio. So the first thing I do is calculate what is my non-housing consumption in retirement. The second step is to then figure out how much income will I need to smooth this income. In other words, to get this number here, how much income will I need? And how I do that is I look at the post-tax tax rate, and I figure out, and I look at my housing expense in retirement and after retirement, and I back into, in order for me to get $35,000, I need $66,000. I then calculate how much Social Security I have, and then I back into, lastly, how much of my portfolio do I need to withdraw to smooth that income. So it looks like I need to withdraw $39,000 a year to ensure that I have $35,000 in non-housing consumption, accounting for the fact that I already have a pension and or Social Security. So this is the key number here. This is the amount of income I need to withdraw from my portfolio, which is based on how much income I need totally minus how much comes from Social Security. Therefore, my retirement portfolio started at $1.1 million. I'm going to subtract $39,000 and put it in my account to live for that year, and then that portfolio is going to grow at 2.87% for the year, and then I copy the formula down. So you notice the portfolio is going down a little bit each year, and it doesn't go negative until I'm 110 years old. So it looks like I still have enough money at the end of my 109th year based on saving 15% of my income every year and based on that Social Security payout, which is pretty high for kind of a middle income earner right here. So back to some of my metrics. I'm going to retire at $1.1 million, which is actually $2.7 million in nominal terms. My portfolio is going to last 109 years. Now I'd have to do a count if statement. I'm saying count if any of these cells are greater than 0. So I try to figure out how many years in retirement I have positive amounts of money in my portfolio. And then I add to that 65 years old, the year of retirement. So I'm age 65 plus I'm adding the number of years in which I have money. And what that tells me is my money will last 109 years. I said I expect to live 85 if I make it to 65. Therefore, there is actually no shortfall years, no years in which my portfolio went negative while I was living. So I actually have negative 24, I'll call them shortfall years, years in which I ran out of money and I'm just living on Social Security. So this is the static model. This tells me I have plenty of money, I'm expected to have plenty of money to last 109 years when I expect to live to 85. So this is the static model. In the next topics, we'll talk about how to take that model and turn it into a simulation and talk about a stochastic process for portfolio returns.